Number 15. Sales of the company. We all know that when we want to invest in any company, we want that company to generate more money out of it, in the way that it should beat inflation at least, if not making any profit for us at least. No matter whatever is good or bad, but the sale of the company should be more, so that all other ratios which we have discussed till now should fall in place for us. So what is sale? Sales is the money which company generates after selling their product or goods. Sale is also called revenues. Number 16. Cash. Cash is what money does the company is having. It is just similar to what cash we as an individual are having. The more cash we have, the more secure we are. Similarly, when the company is having lots of cash, it means that they have leverage to take the risk in order to grow their business. The more cash, the better it is. Always compare the cash of companies in particular industry. For example, you cannot compare the cash flow between Apple and Walmart. Both are totally different industry. But you can compare Walmart with Target or with Kroger. Number 17. Debt. The word debt is intentionally pronounced as death. Debt is a slow poison, which people or company drinks hoping that one fine day they will recover, with all the mistakes they have done in terms of money. The more debt company have, the more hard it is for it to take risks, since there will be less number of banks to lend money, and more number of banks to take money from the company. One thing to note is that sometime, the company takes the loan so that they can take short-term risks to get long-term benefits. So please look for the other parameters before finalizing on debt. Number 18. Revenue per share, or called as RPS. Amount of revenue over common shares outstanding. Answer the question. What's the ownership of sales to each share? Increasing revenue per share over time is a good sign, because it means each share now has claim to more revenue. For instance, if a company generates 500 million in revenues and has 100 million in common shares outstanding, the RPS is 5. For each share outstanding, the company is generating $5 in sales. Formula: revenue per share per quarter equals quarterly revenues divided by common shares outstanding. Revenue per share in year equals trailing 12-month revenues divided by average common shares outstanding quarterly from the trailing 12 months. Number 19. Insider buy or sell. Before you know what is happening in the company, the employees knows before than you. They know what are the products on which company is working, and how it will generate the revenue and can raise the stock prices. On the south side, employees knows much before the common people that company is about to incur huge setback. Many of us don't have permission to walk into some corporate office and ask them what is happening in their company. Then what is the way to find what inside employees think about it? Well, the best way to find that is to see how the executives of company are exercising their options of buying and selling the stocks. If suppose the executives are purchasing the shares, it means all is well. If the executives are selling, then there is some problem. Note to listener: there is common scenario in which the executives sell the stocks when they want to buy home or boat, etc. But when you see that there is rally of executives selling or buying, then it should sound an alarm. Number 20. Stock buyback. Stock buyback is also called as stock repurchase. This is the process in which company decides to reduce the number of shares in the market. Many investors take this as a positive sign that company is making the profit. But this is not the only one reason that company buyback happens. Some of the other reasons are: 1. Company's board of directors may think that there is so many stocks there in the market. The dilution of the stocks may have been done due to employees' stock options plan. In fast-growing market, there is often shortage of labor. So company would have decided to give the stock options to employee in order to retain them. 2. Company's board of director will feel that the stock is undervalued and needs to boost the price. One of option is to buy back, so that less number of stock is there in market, resulting in increase in demand and thus raising the price. 3. Company feels that though they have good cash flow as of now, but in future there will not be so much cash flow, this resulting in paying the dividend and ultimately affecting their profit. 4. Or they don't want extra burden of dividend, so it is better to buy the stock, resulting in maintaining the same dividend. The end. Thanks for watching and please subscribe my channel.